In this chapter, we're going to review financial statements. We're not really going to take an accounting perspective on this. We're just going to review the statements and their construction. We're going to talk a little bit about something referred to as cash flow. And we'll end the videos talking a little bit more about taxes and how they could affect business decision making. So let's go ahead and get started. There are four basic financial statements. The balance sheet gives us a snapshot of a company's position in time. We'll talk a little bit more detail about what that means, but essentially it shows what the company owns and what the company owes. The income statement looks at a period of time. It's an operational statement. So it looks at what has the company done with respect to revenues and expenses over the previous period. Now, the statement of cash flows looks at some basic managerial decisions. How does the company operate? What cash do they generate? What cash is generated from investing in assets like plants and equipment? And then how does the company finance its operations? Now, the last statement is called the Statement of Stockholders' Equity. It really is just a description of how profits are distributed. They are either distributed to shareholders in dividends or they're part of retained earnings. Many times this is actually just part of the income statement that's shown. So again, how that, depending on how the company wants to display this information, in an annual report, there is a separate statement that goes into some very good detail about all of these distributions. So let's look at the statements. Here's the balance sheet. This is actually what we refer to as the left side, right? So this is the left side of a balance sheet. It reflects all the things that the company has purchased, right? These are the assets that the company has decided it needs to operate the company. If you notice, some of the assets are short-term. Short-term by definition is 365 days or less, and some are long-term. Some are physical, you can touch them, and some of them are intangible. The general idea, though, is we show these and describe them in order of maturity, if you will. So cash is at the top. These long-term assets down here have a very long lifespan. The other side of the balance sheet, referred to as the right side, basically just tells us one thing. How does the company buy the stuff on the other side? How do we buy the assets? Where's that money come from? Well, there are really only three choices, right? The money comes from debt, right? And if I can show you here how I can separate, this represents the debt of the company. Down here, here's total liabilities. And the company also can utilize equity. But equity has two parts. It has common stock, and it also has retained earnings. Retained earnings are profits that have been reinvested in the company. So really, there's three sources. There's debt, new common stock, and profits. That's how the company buys the assets that it has purchased. The income statement, as we mentioned, shows a period of time. So this reflects the profitability of the company over these years, right? Each year. And eventually we'll talk about how we'll break this down. Here's gross profit. Then down here is income after depreciation, amortization. Sometimes we refer to that as EBIT, and then down here is the bottom line, net income. Now, all of this information comes from a website, Zacks.com, ZACKS.com. And if you input a company's ticker symbol into their quotes, it will bring up web pages about that company, and you can download this data onto those spreadsheets. This company happens to be Coca-Cola. The next statement is the statement of cash flows. And quite simply, it helps to describe three basic decisions that management makes. Operations. How well does the company operate? If you see here, cash flow from operating activities, right? In 2015, that number was negative. It was positive in 2014. A negative number here is really bad news for this company. We also look at investing. This company appears to be in an investment mode. They are buying assets, increasing their asset base. Down here, we'll see their financing. We'll see that they have positive numbers, which means what? They are increasing cash. So in this case, we see that they're actually expanding this company by borrowing. So the change in cash for these two companies, you see in the end, 2014 was negative, and in general, 2015 was positive. But let's look at a real company, right? Let's see how this looks for Coca-Cola. Here is the net cash from operating activities. And you can see over the years, right, it's fairly steady, right? We're bouncing around 10. The most recent year was 12,625. Now this is in, I think this is in millions. So that'd be 12,625,000 some odd dollars. Then we go down here. Here's the net cash from investing. And you can see that there's a negative number. There's a positive number. Something must have happened there. That we had a positive inflow. So here it is, investments. We must have sold some investments. Negative here, negative here, negative here. So in general, it shows that they're trying to increase their asset base by investing in purchasing more assets. And then down at the bottom, here is the net cash flow from financing. And again, you can see that in general, these are negative. So what that means is that they are repurchasing shares. They're buying back debt, right? Negative here means repaying debt. So they're actually paying off some of its debt. They're also making payments of dividends every year. So we see in general, the financing shows a negative number. So what's the number at the end of the year? What's the net change? That's this number right here, the net change. As we go across here, we see that what? There was negative, positive, negative, positive, positive. So again, what does that tell us? What does a free cash flow tell us about the company? And we'll discuss that here in a couple of slides. So, some ways we can break down the assets that we've been reviewing. There's something referred to as net working capital. That's current assets minus current liabilities. It just shows us the relative relationship between how much money we have essentially in cash, subtract that from the bills that we should be paying in the next year. Now, sometimes we may want to break that down into what's referred to as net operating working capital. So essentially, you take the operating current assets minus the operating current liabilities. So what is that? Net, the operating current assets essentially is current assets minus excess cash. Most companies don't have anything that they would refer to as being excess cash. So for most companies, that's going to be zero. The operating current liabilities, though, we may frequently have to make some adjustments here because sometimes companies have some short-term notes payable. Notes payable are a financing vehicle. They're not an operating vehicle, right? So they reflect borrowing from a company and paying interest. So we need to subtract the notes payable for that. Some companies, that again is just zero, but some companies will have some short-term notes payable. And if we look across here for Coca-Cola, what we're going to find is there's definitely been a decline in their net operating working capital over the past several years. Should we be concerned about it? It's still positive. Relative speaking in dollars, it's still a lot of money. But again, since there is a decline, maybe we want to see what might be causing that. When we get to later videos and we talk about ratio analysis, we may be able to identify where the challenges are here with this operating capital. The next thing we're going to talk about is something called free cash flow. So what is free cash flow? That's the money that's left over to distribute to investors after we've done everything we want to do. So we've run the company for the whole year. We have purchased all the plant and equipment kinds of things that we want. We have also invested in net current assets, right? Our working capital has had changes. So we basically have run the entire company. The only thing that is remaining is we need to distribute money to our investors. Who are the investors of a corporation? Creditors and shareholders. So from this free cash flow, we need to pay interest to our creditors and we need to pay off our debt as it comes due. We also need to pay dividends to our shareholders and possibly repurchase shares from our creditors. So there are really only four things that fall into this category of what free cash flow is for. Now, if there's more cash flow than we need, then we have to think about, well, what should the company do with that money? And we've talked about this in some other chapters. We talked about agency, right? What is best for the company? And as we see here, free cash flow, the last year there was a pretty substantial drop. We should obviously like to explore what happened there. But if the company purchased a huge amount of assets in the last year, we would expect free cash flow to decline. If we saw profits fall in the last year, we would expect free cash flow to decline. One of the things we need to recognize, and we'll talk about this again in later videos, is the tax code, right? In 2018, the corporate tax code was changed to a flat 21%. So everybody pays 21% at the corporate rate, at the corporate income level. So again, that's a brief introduction into financial statements and some key markers that we want to keep track of. Look forward to seeing you in the next video.